What if I told you there is a company growing its revenue by over 123% year over year, holding a near monopoly on the single technology that keeps the world's most powerful AI data centers from literally melting down? And yet its stock has collapsed by 65% from its all-time highs? Welcome back to Smart Stock Sam, the channel where we cut through the noise and go straight to the hard data that actually moves markets. And today we are doing a full surgical breakdown of one of the most controversial stocks in the entire AI universe, Super Microcomputer, ticker SMCI. Is this a generational buying opportunity hiding behind a temporary scandal? Or is it a slow-motion value trap bleeding investors dry while management fights the government? We are going to answer that question with real numbers, covering the brutal price collapse, the revenue explosion, the hidden margin metric most investors are ignoring, the three-headed legal crisis, the institutional capital flight, the short squeeze setup, the upcoming binary catalysts, and the exact trade setup with entry, target, and stop loss. Stay with me all the way to the end, because the trade ticket is where everything comes together. Right now, SMCI is a stock that is essentially paralyzed. It is caught in the crossfire between two forces, pulling in completely opposite directions. On one side, you have a company targeting $40 billion in revenue for 2026, a number so large it would place them among the elite tier of global technology companies. On the other side, you have a Department of Justice indictment and a stock price sitting 65% below its peak. And the cruel irony is that both of these things are true at the same time. This is not just a bad quarter. This is not just an accounting restatement. This is a fundamental existential fight for the company's reputation, its customer relationships, and ultimately its right to continue operating in the United States government's good graces. And the price action reflects that fear with devastating clarity. On March 20th, 2026, this stock suffered a 33.3% single-day collapse. To put that in human terms, imagine waking up and finding that 1/3 of everything you invested had vanished before lunchtime. As of now, we are sitting at $23.22 per share, which already reflects a 25% decline just since the first day of this year. But here is where it gets genuinely interesting for anyone with a value investing mindset. The forward price-to-earnings ratio has compressed all the way down to just 7.69 times. For context, the broader technology hardware sector trades at multiples many times higher than that. The price-to-sales ratio is sitting at a near unheard of 0.28. In the investment world, you typically only see numbers this depressed when the market is genuinely pricing in a non-trivial probability that a company may not exist in its current form within the next 2 years. But before we accept the market's gloomy verdict as final, we need to understand exactly what business we are actually dealing with, because operationally, this company is doing something remarkable. SMCI is not just participating in the AI infrastructure boom. In many critical ways, they are one of the foundational pillars holding that boom up. Their most recent quarterly revenue print came in at $12.68, $12.68 billion in a single quarter. That is not incremental progress. That is a 123% explosion on a year-over-year basis. They are deeply and strategically embedded with NVIDIA, the undisputed king of AI chips, and SMCI's server systems represent approximately 10% of NVIDIA's total end market revenue. But the real story, the genuine competitive moat that separates them from every other server manufacturer on the planet, is their leadership in direct liquid cooling, which the industry calls DLC. Here is why that matters so much right now. As AI data centers scale to process increasingly complex models, the density and power consumption of the GPU clusters inside them creates a heat problem that traditional air cooling simply cannot solve. We are talking about next-generation systems that generate so much thermal energy that they can physically damage themselves without advanced cooling architecture. SMCI does not just sell cooling solutions. They are the recognized technology leader in this category, and that is not a position a competitor can reverse engineer and replicate in a single product cycle. That is the bull case in its purest form, but all the technological dominance and all the revenue growth in the world becomes irrelevant when the federal government comes knocking. So let's talk about the legal situation plainly, because this is the weight dragging the entire stock narrative down. The Department of Justice indictment contains a deeply serious allegation that individuals connected to SMCI diverted $2.5 billion worth of high-end AI servers to China in direct and knowing violation of United States export control laws. This is not a regulatory fine. This is a criminal allegation, and criminal allegations at this scale against a company this size in a sector this geopolitically sensitive carry consequences that extend far beyond any dollar penalty. Then layered on top of that criminal exposure, you have a spreading wave of civil class action lawsuits, with firms including Pomerantz and Robbins filing on behalf of shareholders, and major lead plaintiff deadlines arriving as soon as late May of this year. And then there is the governance dimension. When the company's own co-founder, Wally Liao, resigns in the middle of an active crisis, the signal that sends to institutional investors and corporate clients is one of instability and dysfunction. Appointing a new chief compliance officer is the right procedural move, but it does not instantly rebuild trust with a boardroom that is under this level of scrutiny. This company is fighting three simultaneous battles: criminal, civil, and reputational, and none of them have clean, near-term resolution paths. Now, some investors will tell you to simply follow the institutional money because the professional funds have research teams, legal analysts, and information advantages that retail investors cannot match. So let's look at exactly what the institutional money has been doing, and the answer is not comforting. There has been a net 46.9% decrease in the total number of institutional owners during a recent measurement window. Capital advisors slashed their SMCI position by 80%. Signal advisors cut their exposure by 70%. And Tortoise Capital did not trim or reduce. They liquidated their entire position completely. When you see that many sophisticated professional investors exiting at the same time, the message is clear. They are de-risking because the legal and regulatory uncertainty is simply beyond what their mandates allow them to tolerate. However, there is an important structural nuance here that keeps the bottom from falling out entirely. 84.06% of the remaining ownership base is concentrated in passive index funds managed by giants like Vanguard and BlackRock. These institutions are not selling because their investment mandates require them to hold any stock that sits inside the relevant indices. But critically, they are not buying either. Their neutral wait-and-see posture creates a structural floor beneath the stock price, but it creates zero upward buying pressure. The stock is essentially propped up by institutional inertia rather than institutional conviction. Now here is the hidden metric I flagged at the very beginning, the one that fundamentally complicates the otherwise attractive valuation story. SMCI's GAAP gross margin has deteriorated sharply, falling from 11.8% down to a razor-thin 6.3%. In the hardware manufacturing business, where margins are already historically tight, 6.3% is genuinely in the danger zone. The critical question, and no one has definitively answered it yet, is whether this compression is a temporary product mix issue driven by the ramp-up costs of new DLC systems, or whether it represents a permanent structural erosion of their pricing power in a market that is becoming more competitive. If it is the former, the $40 billion revenue target eventually translates into meaningful earnings. If it is the latter, $40 billion in revenue could still produce almost no profit. And making matters even more precarious is the customer concentration risk sitting quietly in the background of every earnings report. A single, unnamed client is responsible for 63% of SMCI's total revenue, 63% from one buyer. If that client's procurement team decides that the DOJ investigation creates too much reputational and supply chain risk for their own board to tolerate, and they redirect even a portion of those contracts to a competitor. The entire revenue growth narrative can unravel faster than any analyst model can predict. For traders who live in the short term, there is one number that deserves serious attention. The short interest is sitting at 17.12% of the float, over 88 million shares actively betting against this company. The days to cover ratio stands at 3.11, meaning short sellers would need more than 3 full trading days of average volume just to unwind their positions. Any single positive catalyst, a clean earnings report, a favorable DOJ development, a credible settlement, could trigger a violent, self-reinforcing short squeeze. And the options market is already leaning hard in that direction. 77% of current options volume is positioned in calls, with concentrated speculative interest at the $23.50 and $25 strikes for the April 10th expiration. But here is the sobering counterweight. There is also unusual put volume at the $8 strike reaching all the way out to 2027. Someone is paying real money to hedge against a terminal outcome, a potential delisting that sends this stock to single digits. Both the bull and bear cases are actively funded, and both deserve respect. So when do we get resolution? Mark these 3 dates on your calendar right now. May 5th is the Q3 earnings release, and it is the most important near-term event on the entire SMCI calendar. Management must not only deliver revenue, they must explain and defend that 6.3% gross margin in detail. If they cannot provide a credible path back toward double-digit margins, expect another significant leg down regardless of the revenue headline. Then May 25th and 26th bring the fraud lawsuit lead plaintiff deadlines, where the civil legal picture begins to crystallize. And then the truly consequential event, November 2nd, 2026, when the DOJ export control criminal trial is currently scheduled to begin. Each of these dates represents a binary event, the kind where the stock moves dramatically in one direction before you have time to react. This is emphatically not a position you establish and forget about. Despite the legal fog, analyst price targets remain surprisingly constructive. The consensus range runs from $34.53 on the low end to $37.07 on the high end. From our current price of $23.22, that is an implied upside of approximately 50%. But those targets are entirely conditional. They assume margin stabilization, no further DOJ escalation, and the unnamed 63% customer stays put. Remove any one of those assumptions, and the models break instantly. Before I provide you technical trade setup, I need to be completely transparent with you. Nothing in today's video constitutes financial advice of any kind. This analysis is based on publicly available data as of early April 2026 and is provided purely for educational and informational purposes. All investments carry risk, and no past performance or analytical model can guarantee any future result. I am not a licensed financial advisor. Always conduct your own due diligence and consult a qualified professional before making any investment decisions. Here is your precise support and resistance map. We are currently trading around $23.22. Immediately above us sits a call wall at $25, where the sheer density of call options creates a gravitational ceiling that tends to slow rallies. Above that, the 200-day moving average at $28.27 represents the ultimate structural resistance. Until this stock can reclaim and hold that level, every rally attempt is suspect. To the downside, primary support sits at $20.53, the level that held in the immediate aftermath of the indictment. If that breaks, the final psychological floor is the 52-week low at $19.48. For active, risk-aware traders, here is the complete setup. Your entry zone sits between $22.50 and $23.20, anchored to the current Fibonacci consolidation range. Your short-term price target is $27 to $30, achievable if May earnings are clean and no new legal developments emerge, and your stop loss is $19 flat, placed just below that 52-week low. If this stock touches $19, the thesis has structurally failed, and the only correct action is to exit the position entirely, No hesitation, no averaging down. The final verdict: short term, this is a bullishly speculative setup with real squeeze potential and defined risk. Long term, we stay neutral until the margin story resolves and the legal cloud lifts. For conservative, long-term portfolios, SMCI remains uninvestable at this stage. The binary risk profile is simply too wide. But for disciplined, tactical traders who can define their risk clearly and execute a stop-loss without emotion, the setup into these May catalysts is genuinely compelling. And with that, we are done with today's brief on supermicrocomputer. Now I want to hear from you. Do you believe SMCI survives this DOJ investigation, clears that 200-day moving average, and reclaims its highs? Or does the margin collapse and customer concentration risk make this a value trap that destroys everyone who bought the dip too early? Drop your honest answer in the comments below. I read every single one. If this breakdown added value to your research, hit the like button, subscribe so you never miss our next deep dive, and share this with one person in your circle who is watching SMC. Until next time, stay sharp, protect your capital, and I will see you in the next one.